But first, Jahmar, to you, you've been looking at Scotia Bank's 6 month results. Give us the highlights.
Good night, Kalilah, and good night to the viewers. Yes, tonight we'll be taking a look at Scotia's recently published results for the first 6 months of financial year 2023. And as usual, we'll begin by taking a look at the company's overview. Scotia Group Jamaica, it's a subsidiary of Scotia Bank, which is based in Canada, of course, and it's Jamaica's second largest banking operation. The group, it offers a diverse range of products and services, including personal, commercial, and small business banking, wealth management, insurance, mortgages. And over the last 5 to 10 years, Scotia's operations in Jamaica have been significantly streamlined, which includes consolidating several local branches and adjusting their services offered to clients at other branches. Now, to this end, Scotia has made changes to its retail banking network, changing the operating model of 6 locations to digital branches by outfitting them with upgraded ABMs to handle cash and other simple transactions. Now, regarding its outlook, Scotia plans on continuing to use digital technology to maximize their customer first strategy. And leveraging customer insights, the group recently launched Scotia Access, which is a focused relationship strategy for customers with more complex financial needs. Now, that involves um, offering personalized advice and solutions to by way of advisors, digital advisors, which allows customers to connect on the go in a secure environment through mobile and online banking. Now, let's take a look at the meat of the matter, which is their financials for the 6 months, which ended April 30th, 2023. Now, Scotia's performance, it continues to be supported by solid growth across all their business lines and efficient management of their operations, which has resulted in the group recording total revenues of $26 billion for the 6 month period. And this was a growth of 40% from their 18.6 billion recorded in the 6 months of the previous year. Now, this growth was primarily driven by an increase in net interest income, which we see here, which grew by 26% from 13.3 to 18.5 billion. Well, grew 38%, excuse me. Right. So this growth in net interest income, it stemmed from a strong growth in their loan portfolio, higher insurance revenue, as well as higher fee and commission income earned due, earned due to a significant increase in transaction volumes. Now, expenses also increased over the 6 month period from 5.6 to 6.5%. No, excuse me, from 12.9 billion to 14.4 billion, which was an increase of 11.4%. Um, However, this increase was slower than their increase in revenue, which resulted in net profits increasing for the period by 108% from 3.66 billion to 7.63 billion, which is quite a substantial increase, around $4 billion in net income increase. This, of course, resulted in earnings per share increasing from $1.18 to $2.45 for the period. Now, let's take a look at their balance sheet. Now, the group's asset base grew by 37.4 billion or 6%, which was predominantly as a result of significant growth in their cash resources, which we see here, a growth of 21.6% in cash resources, as well as growth in pledged assets, we see here. No, excuse me. Right. in investment securities, which we see here, of course. And total liabilities also increased by 34.1 billion from 489.6 billion to 523 billion. Now, the increase was driven mainly by increased customer deposits, which grew by 40 billion over the period. Shareholders' equity totaled 109.3 billion, which was a slight increase over the period from the 107.39 billion. This was due in part to retained earnings increasing by $1 billion, which we can see here. Now, we'll finally take a look at Scotia Group's price chart. And we have seen the price of Scotia stock decline from highs of $62 in 2018 to fluctuating to around the $35 mark since December 2021. Now, this decline would have started around the same time as Scotia's move to close and divest some of their branches and operations in the Caribbean, which would have spooked some investors at the time. However, notwithstanding this, Scotia has posted commendable results since then during the period, and they would have consistently paid dividends to shareholders, which they will continue to do, considering that they're a subsidiary company, and that's how their parent company gets their income. Now, currently, Scotia's PE is sitting at around 6.9 times, while the finance industry's PE is an average of 9.02 times, implying that at today's prices, Scotia shares are relatively attractive compared to the market. So, in conclusion, we would recommend Scotia as a buy, particularly for risk averse investors who like consistent dividends. And at a time like this, when the market is in flux, this would be an attractive stock for most.
Awesome stuff. So Scotia is one of those companies still paying consistent dividends right now?
Yeah, man. Actually, their board recently approved dividends of 35 cents per share, which will be payable July 20th. So that's next month.
All right, next month. We have a couple of questions here, mostly from Who Am I? Where is it? Who Am I was asking dividend versus growth. I'm not sure that's a question. Oh, here's the next question. He said, but the dividend to stock price is inverting.
Dividend to stock price. Well, I'd have to take a closer look into that one. Their stock price has remained pretty stable between $30 and $34 for some time now. Perhaps he's suggesting that the dividends are decreasing, but I'd have to take a closer look at that one.
Okay. All right, no problem.